Somewhere in the global financial system, a clock is ticking. You can't hear it. You can't see it. But every year the number gets bigger. Right now, the world owes more money than at any point in human history. Governments owe money. Corporations owe money. Households owe money. Altogether, the planet is carrying more than $300 trillion in debt. That's not a typo. 300 trillion. To put that into perspective, the entire global economy produces roughly $100 trillion of goods and services a year, which means humanity owes about 3 times what it produces annually. And yet the strange thing is, most people walk around as if nothing is wrong. Markets rise. Banks lend. Governments spend. Everything appears calm. But systems like this don't break loudly at first. They stretch. They distort. They quietly become fragile. And eventually, something snaps. To understand why, we have to start with a very simple question. Why does the world keep borrowing more and more money? Debt, in theory, is a useful tool. Borrow today. Invest the money. Grow the economy tomorrow. A business takes a loan to expand. A family takes a mortgage to buy a house. A government borrows to build infrastructure. Used carefully, debt can accelerate growth. But there's a catch. Debt only works smoothly when the future grows faster than the debt itself. If the economy grows 5% and debt grows 3%, the system stabilizes. But if debt grows faster than the economy, the gap widens. And that gap has been widening for decades. The modern debt explosion really began in the early 1970s. In 1971, the United States ended the gold standard, removing the link between money and physical gold. From that moment on, currencies became something different. Money was no longer tied to a scarce metal. It became something governments and central banks could create. In theory, this gave policymakers flexibility. In practice, it made borrowing much easier. And when borrowing becomes easier, people tend to do more of it. Governments discovered they could run deficits for years without immediate consequences. Corporations realized cheap loans could boost profits. Consumers were encouraged to finance lifestyles through credit. Slowly, quietly, debt began to grow faster than the real economy. At first, the system handled it. Because interest rates were falling. For 40 years, borrowing got cheaper. And cheaper. And cheaper. Lower interest rates meant larger loans were manageable. A government could carry more debt. A homeowner could afford a bigger mortgage. A company could refinance endlessly. It felt sustainable. In fact, it felt normal. But beneath the surface, something strange was happening. Growth in the real economy, productivity, wages, production, began to slow. While financial growth, asset prices, credit expansion, accelerated. The system was becoming dependent on debt. Not just for expansion, but for survival. Think of it like a bicycle. As long as it keeps moving forward, it stays balanced. But once the motion slows, the balance becomes unstable. Now here's where the math becomes uncomfortable. Global debt has grown roughly 4 times faster than global GDP since the 1980s. That means every dollar of economic output now supports far more debt than it used to. In other words, the system needs more and more borrowing just to maintain the same level of growth. It's a bit like needing stronger and stronger coffee every morning just to feel awake. Eventually, the dose becomes absurd. At some point, the question isn't, is this efficient? The question becomes, is this sustainable? History suggests the answer is usually no. Debt-driven systems tend to end in one of 4 ways: inflation, default, financial repression, or restructuring. Inflation is the quiet one. Governments allow the value of money to erode over time. The debt stays the same in numbers, but becomes easier to repay with cheaper dollars. It's a subtle transfer of wealth from savers to borrowers. Default is louder. Countries or institutions simply admit they cannot repay. Creditors take losses. Markets panic. Trust evaporates. Financial repression is more bureaucratic. Governments keep interest rates artificially low and encourage institutions like pension funds and banks to hold government debt. It's a controlled environment, but it limits economic freedom. And restructuring is the messy negotiation where debts are partially forgiven, stretched out, or reorganized. History is full of examples. The Latin American debt crisis in the 1980s. Japan's massive debt buildup after its asset bubble. The global financial crisis of 2008, triggered by housing debt. Each time the system appeared stable, until suddenly it wasn't. And here's the irony. The policies used to fix debt crises often create even more debt. After the 2008 crisis, central banks slashed interest rates to near zero. They injected trillions into the financial system. The goal was to stabilize markets. And it worked. But cheap money also encouraged more borrowing. Governments ran larger deficits. Corporations issued record bonds. Investors chased riskier assets. The financial system recovered. The debt kept growing. Then came the pandemic. Governments spent unprecedented amounts to prevent economic collapse. Again, the intention was understandable. But the numbers became staggering. In just a few years, global debt jumped by tens of trillions. Which brings us back to the present. Today, the world economy sits on top of the largest pile of debt ever created. And for a long time, extremely low interest rates made that pile manageable. But something changed recently. Interest rates began rising again. And higher rates transformed the debt equation. Suddenly loans become more expensive. Governments must devote larger portions of their budgets to interest payments. Companies must refinance at higher costs. But also more fragile. None of this means collapse is inevitable tomorrow. Debt systems can stretch longer than most people expect. Governments have powerful tools. Central banks can intervene. Markets can adapt. But the underlying math does not disappear. Debt must either be repaid, inflated away, or restructured. There are no other endings. And that raises an uncomfortable question. If the world continues borrowing faster than it grows, if the financial system becomes more dependent on credit each decade, and if interest rates can no longer remain near zero forever, then the real question isn't whether the debt era ends. The real question is how. Quietly through inflation, suddenly through crisis, or slowly through years of economic stagnation. Because somewhere in the financial system, that clock is still ticking. And sooner or later, every ticking clock reaches zero.